Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In this installment, we're going to talk about the importance of embracing the wisdom of uncertainty. That doesn't come easily to any of us. And yet, embracing uncertainty is a critical ingredient to being successful with our investment portfolios, our retirement planning, and really, quite frankly, our life planning. So you'll enjoy this installment. Now, if you're new to this channel, make sure you hit the subscribe button. We're posting content all the time, so you'll be alerted to our new content. And if you like the video after you watch it, give us a like. So embracing the wisdom of uncertainty is a really critical piece of retirement income planning and financial planning in general. I'm going to give you some background. This chart I've used a few times before, but it's really important context for this discussion. So if you go back to the 1980s, the early 80s, even through the 90s, interest rates were much higher back then than they are today. So savers were well compensated for setting aside money in their bank accounts or their term deposits or GICs. But over the years, interest rates have continued to fall from the high water marks back in the early 80s down to 2014 in this chart, and they're even lower now as central banks have responded to reducing interest rates to cope with the pandemic effects on the economy. Now, the implication here for many people getting ready to stage for retirement is that we have to rethink some of the rules of thumb that come our way when it comes to retirement income planning. So a rough rule of thumb is take 100 minus your age. That's how much you should have in your portfolio in growth assets or stock market related assets. So if I'm 65 today, I shouldn't have any more than 35% in the markets. Now, that probably wasn't a bad recommendation back in the 90s or even in the 80s when interest rates were high. Yes, inflation was high, but the yield was very good. And what happened back then as well is that investors in more conservative investments like bonds got yield in two ways. One, they got the coupon, so the interest rate that the bond was paying, but they also got price appreciation on the bond. So bonds, Government of Canada bonds, provincial bonds, corporate debentures, the bond market is constantly pricing those bonds every single day. And the price of your bond is going to be valued against its interest rate, against prevailing interest rates, the term to maturity of that bond, and the credit quality of that bond. Those would be some of the main ingredients that would drive the value. So let's say you and I have a bond paying 4%, and interest rates in the economy go down to, let's say, 2%. And let's say my bond isn't maturing for another 10 years. You've got a really solid commodity on your hands. So anyone that wants to buy your bond would be required to pay a premium. Who wants to buy a 2% bond if they want 4%? But yet you won't sell that bond unless you get a premium. You would never sell a 4% yield into a 2% environment without getting that premium. And the degree of the premium you get will be a function, like I said, of the maturity date, the credit quality, type of bond, and the interest rate on the bond. So investors over this whole time period rode a wonderful bond rally. They got the interest rate, but they also got steady price appreciation for the most part on bonds. So that recommendation of get more and more conservative as you get older worked really, really well for these folks. The problem is that particular recommendation is not going to work so well for retirees going into the future. First of all, interest rates are not likely to go any lower. Certain parts of the bond market may be a little bit more, but for the most part, interest rates will be stagnant and may eventually go up. That means the price appreciation that I just talked about will not be on the table for the next generation of retirees, as an example. The other thing is interest rates are quite low right now. So if you're looking at 10-year government bonds paying, 1.5% or 1.25%, or maybe at some point 2.5%, that's a really poor yield. When you think that inflation is averaging, let's say, 2.5%, if you're only getting 2.5% in your bond, you're not keeping up with inflation. So the practical reality is retirees have to look at other options. If they don't, they're going to go through their capital too quickly. One more point in this chart. Back in the early 80s, you needed roughly $150,000 to $160,000 of capital to generate $25,000 of investment income. In 2014, you needed far more than that. In fact, I've got another chart that illustrates this. So in 2019, to generate $25,000 of interest income every year, you needed $1.4 million. In 1982, you needed $155,000. That's the dilemma that investors face today. We need to get our money working much harder for us, and really at the end of the day, the only way we can do that is we need to be embracing uncertainty to a certain extent to reach our long-term goals and objectives financially. And that's a challenge, because when we move into retirement years, we don't want to be embracing uncertainty. We want as much certainty as possible. And I'll talk about some strategies that we can take a look at to build some additional certainty into a plan that is embracing uncertainty. Now, the first thing that you need to do is you need to take a look at your own planning and come to a decision point as to what return that you need to reach your goals. This is very individualistic. It's not a generic number. You have to sit down either on your own or with a retirement income planner as an example to figure out, when it comes to investing, what return do you need to achieve in your portfolio to achieve those goals and objectives. That's the first step. So again, you can do it on your own, or you can hire a retirement planning consultant to help you with that exercise. Now, once you do that, there'll be a range of portfolios you might select from. So this is at a very basic level. You can get more detailed than this, but this is a great chart that Vanguard put together looking at returns from 1901 to 2018 or 2016, I guess it was. And inflation, averaged 3 to 4% over this entire time period. And if you look at, let's say, a portfolio made up of 100% stocks, it averaged 8.9% compounded returns over that time frame. And its best one-year return was 36%. Its worst one-year return was 19%, with an average of 8.9%. So the challenge with this portfolio is, although it gave the best return on average of all these portfolio mixes, it also had the widest range of one-year return possibilities. If I go to a portfolio of 40-60, which is 40% bonds, 60% stocks, that portfolio averaged 7.6% per year, a high of 23.7 in 1 year, a low of -9, almost -10% in a year, with an average of 7.5. Now, what happens with these portfolios is, obviously, the more bonds you have, the less total return over time, but also the less fluctuation. So when you begin looking at your own objectives, so let's go back to this number here, when you do your planning and confirm your return number, then what your advisor should do is sit down and go, well, here's the mix of investments that has the highest potential of achieving the goal return that you have. So if the return requirements, let's say, were 7%, that means I'm probably going to have between 50 and 60% in the stock market to reach those returns, but there will be this range of returns. What we know over time is that on stock assets alone, you're going to have anywhere from 2 to 3 losing years in any 10-year period. Now, the long-term averages might come in line with exactly what you're shooting for. The year-by-year returns can be quite variable. And we'll talk about how you can deal with that variability in the short term, particularly as you get close to retirement and have to fund income from your portfolio. But that's the first part. Confirm your return. Your return and risk comfort level will define your investment mix, and it's the mix that's going to drive you towards the return objectives that you're trying to shoot for. Now, once you move down this path, all of us would love to be able to just buy government bonds or GICs or term deposits to achieve our goals. Clearly, that's not achievable given the interest rate environment that we're in today. So the other part of investing is we need to understand and really face the cycle of investing. So what gets in the way of people succeeding with their portfolios is they don't have the stomach for uncertainty. They ride these highs and lows. So portfolios are doing well, they feel emotionally really excited about it, almost euphoric. Then they see markets going down and they get depressed, and there's anxiety and panic and sometimes capitulation. They leave the market, and then on it goes. So to be successful with stock market investing on a part of your portfolio, you need to be really disciplined emotionally. That's difficult to do, and that comes with coaching, it comes with education, it comes with a plan. If you've got those things in place, you have a higher probability of not allowing this emotional roller coaster get in the way of you achieving your financial goals and objectives. Okay? If you need growth assets in your portfolio to achieve the returns you need, then you need to get your head wrapped around this idea of embracing uncertainty and the fluctuation that can take place in the markets. If you can't emotionally, so if academically you find out that this is what I need to do to achieve my goals, but I'm not going to sleep at night, then really what you need to do is go back to your plan and readjust those goals and objectives, right? So don't let the investment tail wag your planning dog. You want to make sure that to sleep at night, well, maybe you have to back up a retirement date because I'm going to get less return. Maybe you have to save more because I'm going to get less return because I only feel comfortable with safe haven assets. I think there's a middle road where you can have both and not have to defer your retirement forever to get the kind of cash flow you want, but you do need to embrace this cycle of investing. A great example has been this past year. So this particular video has been produced in 2020. You can see that leading up to March of 2020, we saw the U.S. stock market go through a major correction because of the pandemic. And this is the definition of uncertainty. And then a few months later, I put together this chart, and we saw that the U.S. stock market had retraced a lot of its losses and was beginning to improve. That continued to happen, so that as we look at the this past year, let's see if I can find it here. I think this is this past year. It had fully recovered and was actually higher than its highs back in February. No one would have bet that going into the correction in March, the third week of March. This is just how volatile it was. So this is, again, the definition of uncertainty. You can see the U.S. stock market here. We had the COVID shutdown of the economy. Markets dropped 33.7%. But then within a very short period of time, between March 23rd and April 8th, it's roughly 12 days, we saw the market go into bull market territory. It wasn't a straight line, but it steadily went up, so that by the time we got to the fall, the U.S. market had retraced the losses that it had experienced. So it was extraordinary. But this is a good example of some of the short-term volatility that can happen. Obviously, this was an extraordinary event, but extraordinary events can happen. So anyone that capitulated here and sold out likely didn't jump in right away and probably missed most of this momentum. So a lot of investors were just so jittery they just never went back in, sold their positions, and missed the rally. This is another example of what we're talking about when it comes to embracing the wisdom of uncertainty. This particular part of the chart represents the stock market downturn through the 2008 financial crisis. Very difficult time in the market. It lasted 14 months. And then once we got through the crisis, the green represents the increase in the market, about 70, almost 80 months. And it was far in excess of the losing months, and we retraced that value. Now we've had some minor corrections along the way. 2018 is a good example. We saw the market correct here because of interest rates going up. But with every little correction, or with every correction, I shouldn't say little, but with every correction, which is a red here along this axis, the recovery that followed it was extraordinary. It's very difficult to do this, but the first thing is when you go through these periods is you don't sell out and try to miss the bear. You just need to hunker down and get through it. If at all possible, you want to add money to your portfolio during those periods, because the probability is that we're going to see pretty good recovery in capital markets. This is another example that we've used. This is going for a number of years from 1956 to 2016. And all it does is look at the bull and bear markets over that time period. The average gain in a bull market was 156%. The average length of a bull market was 51 months. The average loss was about 27%. And the average length of a bear market about 14 months. So bulls, the good markets, lasted 51 months on average. Bears, about 14 months on average. Average increase, like I said, 150. Average decrease, 27%. This is it. Schematically, you can see the drawings of the blue, which are the bull markets on this axis above the zero, and then the bear markets here. So again, it's important to really embrace this knowledge so that when we hit periods of uncertainty, we can make the right decisions for that period of uncertainty. When we're in the midst of it, it's very difficult to do. But we need to use these historical facts to give us some idea about what the right actions are to take when we go through those experiences. This is another chart about embracing the wisdom of uncertainty, and this is looking at calendar year returns. Again, this chart was taken from 1980 through to 2014. The blue lines here represent positive years, and the reddish-orange lines represent the negative years. You can see there's way more positive years over that time period than negative years. And this roughly aligns with what I said. 2 to 3 years, you're going to get out of 10, you're going to get negative performance. Usually it's 2 lousy years and 1 subpar year. But what's interesting is I think every single year here you see this red dot. And the red dot represents the intra-year return, where at some point in the year the market was actually in losing territory. and then by the end of the year, it was in positive territory. So a good example that I remember firsthand when I was new in the business back in '87, the market was down, 35%, let's say, in the U.S. markets. And there was a lot of capitulation. A lot of people left the market at that time. And then by the time, that was in October, by the way, and by the end of the year, see this little blue here, the markets were positive, right? Extraordinary. So this is uncertainty. This is the definition of uncertainty. Every single year, including the years in which the markets ended up positive, there was a point in time in the intra-year where it was in negative territory. That comes with equity investing. So again, if we go back to first principles, what return do you need to achieve? That gets driven off your financial plan. That return will drive the investment mix. Given the extraordinarily low interest rates that we're in, it's going to take some alternative assets and maybe stock assets to drive the returns. That's to deliver return over time. If I'm 60, I have another third of my life to live in retirement, I want to have growth in my portfolio. For that part of my portfolio that I need to use to fund cash flow, I'll be very conservative with that. That money does not need to be in the market. That money could be in individual bonds, it could be in term deposits, GICs, cash accounts. But you need to have a portion of your portfolio in growth assets so you can get competitive returns over that last third of your life when you're retired. So what are the key messages from that chart on uncertainty? 28 out of 35 years were positive. On every year, the intra-year was negative. On average, that intra-year decline was 14%. The average return over the entire 35-year period that I just showed you was a 9% per year with a cumulative return of over 1,800%. In the short term, the stock market's a voting machine, but in the long run, it's a weighing machine. It's Ben Graham, famous investor. And what he means by that is that the market will take into account consensus opinion on the facts. And so in the long run, it's going to weigh those facts. In the short run, you get votes and you get sentiment, and it's a popularity context. It really doesn't contest. You don't really get a clear idea what's going on in the markets. But over time, the market weighs all available data and gives you sound valuation levels about what stocks are worth and should be worth relative to other alternative assets that might be out there in the marketplace. Now, how does the average investor do with this information? And this is where I'm biased because I think coaching is really important, but this is the S&P 500 index, stock index, based and compared to the average stock fund investor over 20 years ending December 31st, 2012. And the S&P 500 over that time period did roughly 8.21%. The average investor did 4.25%. And when quantitative analysis was done on this by Delbar, what they found was this performance gap or investor gap was mainly due to the fact that investors were doing exactly what they shouldn't do. So remember that emotional roller coaster where people were getting anxious when the market was going down and then capitulating and then maybe getting excited about going back into the market when it was doing well? Well, that's exactly what was going on. So investors typically sell out at the bottom of the market, they get excited and go back in. They do not behave in a way that's going to increase the probability of them achieving their return objectives that they want to experience. It's all about what's in your headspace. So are you emotionally disciplined enough to go through that uncertainty to ultimately achieve the objectives that you're shooting for with your portfolio? So what happens is, and this is where we get into a little bit of information that is not directly related to investing, but to the extent that we're under low-grade stress, and right now is a good time, but anytime you go through economic calamity, personal transitions, the pandemic, as we're doing this recording that we're going through right now, that low-grade anxiety and stress creates reduced cognition. That's just a reality. The anxiety, and we become reactive when we're experiencing those things. And so I have a strong bias towards coaching and the coaching model, because the coaching model is so powerful and yet so simple. So what is coaching? It's getting to know our clients' dreams and goals. It's assessing their current situation, talking together about any gaps or opportunities to be exploited, developing an action plan, helping the client implement the plan, providing accountability and encouragement to stick with the plan, and then review and fine-tune along the way. I don't care whether it's your finances, your retirement plan, your diet, your relationships. If you apply this model, you will make extraordinary progress in any area of life. And so we think right now, particularly given everything that we're going through with the pandemic, coaching more than any time is probably needed because of the low-grade emotional stuff that people are having to deal with. This is a very interesting chart that I sometimes show people, which talks about the value of coaching in the financial arena. So this is over and above the return potential that clients will get on the actual investment securities we put in the portfolio. I'm not going to get into this chart in a lot of detail, but I'll focus on the behavioral coaching. So Vanguard and Morningstar did a study, and they found that anywhere from 1.1 to 1.5% per year of additional financial value over a long-term relationship with an advisor was taking place for clients. That was over and above the investment value that clients were experiencing. Other areas could be comprehensive planning, rebalancing the investment mix, tax planning, deaccumulation strategies for retirement, and potentially the added value could be as much as 2.5 to 3.5% per year on average. That is the power of the coaching model. If it's consistently applied, it really brings significant value over time. Well, I hope you enjoyed this presentation. Again, if you're new to this channel, hit the subscribe button. If you want more resources on retirement income planning and wealth planning, you'll see in the notes to this particular video extra links that you click to get those resources, and don't hesitate to do that. Wishing you all the best in your retirement and wealth planning journey. You take care.